All right, welcome everybody. This is a going to be, as the email I think said, fast-paced. It is going to be extremely fast-paced, and I wanted to welcome everyone to a couple things that we're going to introduce tonight. One is a trend identification technique that I've been using for decades, literally decades. And with that said, we'll get right into it. I know tonight there is a probably one of your favorite presidential candidates having a town hall meeting on two different TV stations. I believe it begins at 8 p.m. Eastern Standard Time, so that everyone, if they wanted to see their favorite candidate in their town hall, we will make sure that you get there in a timely fashion. So we're just going to get that. All right, so let's get rocking. First, take a moment. This is a disclaimer. Trading is risky, involves risk of loss. Stops, well, stops are not for sissies, as I always say, but stops do not necessarily limit losses, especially if you have a situation where the market gaps. They don't really say that in that legal sentence. But sometimes the market gaps and you're going to lose more than your intended amount. It's very important to understand that. All right, next, let's move on. Bullish market conditions. You know, I love this slide. I've taught this slide for, I don't know, probably since I started teaching. I started teaching brokers when I owned a brokerage firm. And basically, it's all about where it's not important as this line is pretty much the center focus of tonight's presentation. It's not important how the market opens as much as how the market closes. And that's not necessarily true to a degree. But the close is where all our monies are assigned, and it's where we get closes, and it's the relationship of the close, and again, to past price action. I'm sure some of you have heard me mention the close related to past price action. So we'll take a look at just this one little concept here tonight, because we're going to focus on a very important element in my trading, which many of you know. I'm very mathematical. I'm around logic, and I base a lot of my trades on statistics. So when you have what we would call this dash line here that you see, that would be created from a last conditional change from that bar right there. What is the last conditional change? Last conditional change is a setup, which means this bar here closed below probably the prior bar's low. And it means the high of that bar becomes resistance until the market closes greater than the last conditional change line, which would be the dash line. When you get a close has to be greater than. It cannot be equal to. Equal to, no bueno. Sometimes, coincidentally, it'll work, but a close greater than by 1 penny is still considered greater than. And that's why a lot of times you see the markets hit these last conditional change resistance, they back off, they stall, but once you get the close greater than said resistance, that's when magic happens to the upside. So the close is always important. It's the relationship of the close as it regards past price action. A close greater than the resistance is one thing. The close greater than past or prior highs is important. And then tonight we're going to talk about maybe the close greater than opens of a specific time frame. That's what we're going to discuss a little bit tonight. Yes. So I love this slide because it really illustrates from all the years that I've taught, conducted in-person seminars, spoke at conferences. If I ever ask the audience, tell me what you think a bull market is, people would always say higher highs and higher lows. Well, that's okay. But shooting star has a higher high and a higher low, but that doesn't necessarily mean that's a very strong trend. It means that the trend could be exhausting itself. So what I like to teach people is a better market condition of higher highs, higher lows. And then it says it right here. And this is, I don't want to trick people, but I've never really taught all the tricks up my sleeve. But the market closes greater than the open. Let's focus on that for a second. The green candle here shows that's the close and that's the open. All right, great. That's a bullish condition. But if the market in a shorter term time period is closed greater than the beginning of the session's open, well, that now shows that on a, if this is, say, a, let's pretend this is, well, we don't have to pretend, it's a 15-minute chart. Let's say that that's the open of the day, the open outcry. Let's just say that is. The market opens, it trades lower. When the market closes greater than the open, it also starts to signify that perhaps the low of the day is in. Interesting concept, which we'll define in just a few more minutes. So what defines a bullish market condition? Higher highs, higher lows. Okay, good. But what constitutes a really strong or a true market bullish condition? The close is greater than the current bar's open. The close is greater than past closes. The close is greater than past highs. And what really would help is if the close is closer to the current bar's highs. So that really does illustrate a stronger bull market trend, right? A bearish market, it's just the opposite. So I want to go into a couple things that we've done in our work here. And a lot of stuff that we've done for using back testing studies has been used on TradeStation platform. Many of you already have the John Person lifetime indicators. Some of you are VIP members. VIP members, a annual membership which comes with a slew of additional indicators and also privileges, I guess you would like to say. We have all types of volume at my John Person proprietary volume indicator, the PMC. And one of the things that we're adding here now to the VIP, if you're a VIP member, it doesn't cost anything. Anytime we come out with a new, not an indicator, but something like the LCC or a new scan that we've combined our things with, and one of an additional scan that we're going to be coming up with is just kind of what I've been talking about, this open close indicator. And I'm not, don't get me wrong, I do this and I've done this for decades manually. And I think in my very first book, first book, I talked about a back test study that I did, which suggested that 67% probability that 20% of the time frame of a market's trading session will mark the high and low of that session 67% of the time. Now, that doesn't mean it's a guarantee. It just gives you a statistical edge. The edge is to your house, like to your side, like the house at the casinos. So if, for example, the market opens, trades lower, and one of the concepts, and I'm going to just jump into it right in just a minute here, is on a monthly basis, something we've done in our live trading room, and I've alluded to this many times during this year specifically, which has helped us numerous times. Last month saying potentially the high is in for the month, which it was, or now this month, October, potentially the low was in for the month, or back in April. I remember distinctly having a new individual come into our live trading room and said, "Where did you get that information from?" And it's like, well, I didn't whip it out of my keister. I came up with it about, I think it was 18 years ago, and it was published in my first book. And it was interesting because I do understand a lot of people get a lot of things thrown at them. There's a lot of emails. There's a lot of garbage out there in this world. There's a lot of, well, I'm on an open mic and a recording, so I don't want to say BS, but we'll just leave it at BS. There's a lot of bunk out there, that's for sure. And so when you find someone that's trying to help people, you know, there's a lot of hesitancy, and I understand that, believe me. When I first got into this business, I mean, you didn't really have mentors. You didn't have people educators. It wasn't really like that. You know, I was fortunate enough to work for somebody, George Lane, the guy who created and is credited for popularizing the indicator known as stochastics. So I had someone that was really, really, really good and knowledgeable in technical analysis and got me into a lot of the statistical edge type information and Not just that, but seasonality. And boy, I mean, he was pretty famous, and he attracted a lot of famous visitors in the office. And so, I mean, here I am, a 20-year-old kid, and I'm learning about something called the Kondratiev wave cycle. I mean, I don't think anyone in this day and age would even know what the Kondratiev wave cycle is in the field of technical analysis. You really have to go back and study this. Elliott wave, it's a little bit different. So I've been exposed to almost every form of technical analysis, and rightly so, because when you're trading your own money, you better be real right, real quick, or you're going to run out of money and you're going to be looking for a new career. So I've come up with a lot of things. I used pivot points. I used moving averages. I came together and created the two. I've seen the changes through the decades of how we look at different markets. I have seen the plethora, and that's a big word, and it means a lot, a myriad, thousands of indicators that are built. I mean, if we go and just look at Thinkorswim alone and look at all the indicators they have, I think JJ Kinahan had told me a few months ago that they were up to about 423 price-based indicators. He says it's ridiculous. Someone hears someone talk and they go, they want it created, and they're very, very, very customer service orientated. And the funny part is, friends, how many indicators can we build on 4 common denominators, which is called the open, the high, the low, and the close? Even myself, I probably have too many, but I have the right ones for the right things. So what are those? Well, I'll go through this list, and I can just do an honesty check for myself. I mean, I'm not gonna do someone else's inventory. I'll just take my own inventory. That makes sense, right? Do I, John Person, do I have too many indicators, and are they worthless? Well, first off, I believe in volume, and what I did is I modified a volume indicator, modernized it. Instead of looking at volume like OBV, which we still use, but what I did is I took a look and modernized this indicator of volume and did it in terms of percent changes rather than looking at absolute volume changes, and put it in a momentum histogram. The volume indicator is very powerful. It works very well. It uncovers convergence. Divergence is better than anything that I've ever seen. The next one, so that actually gets a double check. Actually, we'll give it a triple check. The next one is the relative strength, comparing one product to another in terms of percent change over time. Same concept. This is a non-price-based indicator. It just is a relative strength tool used to define if a stock is relative to the index, moving up, weakening, lagging, or improving in performance. This one I give, if I could give it 5 stars, I would. But again, this is only good for using against stocks or ETFs or other indexes versus the S&P 500. This indicator is not to be used as comparing the E-mini S&Ps to the E-mini S&Ps. That's just not what that works. The TSI indicator for short-term, long-term dependency. If you're interested in finding out if the weekly or the monthly and the daily and the 60-minute or the 15-minute or the 5-minute is in sync. In other words, do we have a buy signal? Is the monthly trend up? Is the weekly down? Is the weekly up, the daily down? Is the 60-minute up and the 15-minute down? And again, the TSI indicator helps us identify just a simple concept that you're in a higher time frame trend mode, bullish or bearish, and that the short term is now in sync with the higher time frame. I find this to be useful for all facets of trading. My trilogy scan, phenomenal stuff. That's a scan, so it's not really an indicator. The last conditional change, that's amazing. That tells me if there's a true breakout of resistance or a breakdown of support. We also have the high close, low close radar screen. This will give us in real time what might happen rather than what did happen. So in other words, a high close and a low close doji on the radar screen, this will warn us before the close, hey, the market is generating a buy signal right now. And that to me is very powerful. Now, the Mcclellan Oscillator, this is a breadth indicator. where we took Sherman McClellan's work, which I didn't call it my work. It's his work, but I modified it. And I modified the settings, and I changed the settings slightly for each respected index. This was originally created as an advanced decline component of moving averages in an oscillator format that would give multiple buy and sell signal in variations, meaning an overbought, an oversold, a zero line movement. So there were sell signals if it's overbought. There'd be a sell signal if the market crossed the zero line. There'd be a buy signal if it was oversold. There'd be a buy signal if the market went back up above the zero line. Now, what we did is listen carefully, this is very important. I said that the Mcclellan Oscillator was originally created and constructed based on the New York Stock Exchange Composite Index. Nobody's trading that because it's an index. There's approximately 1,800 stocks in that index. 68% of the stocks in that index are interest rate sensitive stocks. So you have REITs, you have utilities, preferred stocks. Okay, great. Now the NASDAQ 100, again, I just let the secret out, has 100 stocks. The S&P 500 has 500 stocks. And then the Dow Jones Industrial 30 average has only 30 stocks. So here's the question. How do we use an oscillator that's based off moving averages on an index that has 1,800 stocks to move the needle and use it and apply it to the NASDAQ 100? Well, shouldn't we change the parameter settings if there's a moving average component to maybe modify it to adjust for only an index that has 100 stocks rather than 1,800? And the answer was yes, and we did. Not only that, but we made it so that it would be dependent or independent of each respected index breadth analysis. In other words, we take the S&P 500 data and take the advancers versus the decliners and apply it with the Mcclellan Oscillator. That's what we created. Now what's to come is it's in my hands, and it's called my open close indicator. So I've been talking about this a little bit in the live trading room, but we have an open close indicator, and not only we're going to make it as an indicator open close, but we're also going to create it as a keyword, a scan. I'm really excited about this because I'm finding more and more high quality setups other than having the identification of using maybe, is the breadth strong? I should be a buyer. But if the market opens and then it starts to trade down, and if we have an open close indicator that says after so many days, if the market goes back above the open for a time period, we have the assumption now that the low for that time period is in. Interesting. Well, if this is the monthly chart and you have identified that the market is now back above the opening range. Now, it's easy to do for the S&Ps, but can you scan 500 stocks and say, how many stocks are now back above the opening range? Now, if it's in a given month, and it happens within 20% of the month. Now, how many trading days are in a month? 20. So what's 20% of 20 or 21 days or 22 actual technical days in a trading month? So what is it? 5 trading days. Within 5 days, if the market is closed greater than the monthly opening range, so that's where it gets a little confusing for people. So if the monthly opening range, and we can find that the market is now closed greater than the monthly opening range, we have maybe the assumption the low is in for the month for that particular index, ETF, or stock. And to me, that's very powerful information. And that's one of the things that we're doing here. There's a few other things that we did a few years back, and I mean a few now. I can't believe it's been 5 actually. I think we're close to 4.5 years. Excuse me, 4.5, not quite 5 yet. Don't have it. I built this with Ben, my partner at J Person Asset Management, to help us develop strategiis. And it first started off so that I could build strategies, and we created a monster. And this is called the Algo 17. It was 17 different versions, I think there were 2 different versions of that, and we put 18, and I'll tell you what 18 really stands for. Good luck. That's all it is. 18, it's a very auspicious number. It's good luck. I'm not saying I'm superstitious, but 18 is good luck. So it's all that means, because we find this to be a very powerful tool. This tool allowed us to not just choose the time we want to trade, but optimize the best time to trade, meaning the best time, not from volume, best time of profitability. Should we be trading before the open of the open outcry? Should we be starting to trade at 8:30 in the morning, 8:40? Should we stop trading end time? Well, if you think about it, that's 4 o'clock minus 105 minutes. So stop trading everything 105 minutes minus 4 o'clock. Interesting. Position sizing. We wanted to develop something that had position sizing. So we have 3 choices. A stagnant account size, put me in as many positions as possible that my account will handle. A risk, put me in as many positions as possible as that amount of risk. So what does that mean? This signifies that position risk states that if the risk is $300, it'll put me in 3 contracts. If the risk is $100, it'll put me in 10 contracts. If the risk is $900, it's going to put me in 1 contract. Or I could choose, just put me in stagnant positions. 1, 2, 5, 10, 100, whatever. Money management. We created a, I don't want to lose on day trading anymore, optimize. Every one of these functions were optimizable. It was really, I think, a stroke of not just genius, but really the amazing ability of putting together the technology that TradeStation offered and the logic that we threw in with our work. Specifically, should we use a last conditional change, a dynamic, or a compression strategy on a trailing stop basis? Should we give ups, like add a couple extra ticks to stop losses? Should we get out a couple ticks before the actual profit target? We have entry signals. We broke it down so that we could take buy signals, we could filter them out with moving averages. And here's another thing. We didn't just say a moving average. We said, what kind of moving average? We could take a moving average of a high, a moving average of a low, or a moving average of a close. And I don't know which one to use. Well, guess what? Just put in the optimization field and the parameters and let the computer tell us. Wow, that was unbelievable. It really did help. These were some of the functionality. Holding period. What's the best holding period? Should we, and one of the, I think the smarter things that a system could do for us is, do we enter a trade at a market order or do we enter on a stop order? How the hell do I know? What's the best way of doing it? A lot of times you get a market, it breaks out, market closes above a resistance. Now, how many other times have you ever seen a market immediately, the next bar opens slightly lower and just tanks straight back down, forming what we call the equal and opposite, or a 2-bar reversal? What this function did was say, maybe don't take a market order and enter at the next session's open, but place a stop above the breakout bar's high. Add a tick to that, plus 1 tick. Add a stop in, plus 1 tick above the bar's high. So that if it is going to go south on us, we won't be in the trade. But not saying that's going to guarantee a win, but it helps filter out a lot of losses. Imagine this. If the market's truly bullish, what should it at least do? Make a consecutive series of higher highs. So if a buy signal is truly valid, it should make a higher high and at least by 1 tick. And now we have a fighting statistical edge that we are in a defined uptrend. So that was a smart way of doing that. So we had many things in my career that we've put together that we use and I utilize to this day. So what I wanted to point out and to share with you in tonight's presentation is that this is one of the models that we built, by the way, with the S&P 500. And if we go over here and to format strategies with you guys, you can see this is 17 Extreme version 18. And everything that I just said, just to share with you as a quick review, it's everything that's in this PowerPoint is right here. So we haven't really changed anything. It's pretty powerful. And in an environment that we have While not every trade, red lines here show losers. That's a loser right there. Not every trade, it got out on a compression stop. Actually, it went right back in on a long today, by the way, at the end of the day. This is one of the models that we created we had a summer school. There's another famous one we have called the Razor Focus model. All of them on these spiders have really spectacular returns and have survived the most unbelievable. I mean, it's brutal, the type of volatility that we see in the market. When I say brutal, how many people, it's funny. No matter, I've been saying this recently this year, that this is the kind of market that can make even the best trader look stupid. On a given day, you say, hey, the market's breaking out, we ought to get long, and it just pukes on you through a presidential tweet. And then someone gets short, and they go, see, I told you the market was going to crash, and then the market zings up on them. I mean, this would make bulls, and this market environment makes bears look stupid. And by the way, I did see someone tweet, any good technician saw this market was going to sell off. And I haven't seen them how they did after that. So what I'm seeing in the market is lots of nervous shakeouts in the marketplace. I'm not saying it's easy. There's been some, I mean, if you guessed that the market's going to go down here, would you have guessed that the market should go down here too? What gave you the guess here versus over here when the market gapped up against you? Or maybe you sold it short today on a gap lower. That would have not felt friendly. So I'm not saying that the market is easy. We need some certain logical tools. Listen carefully. We do need logical tools to help us navigate the market consistently, not get lucky once or twice. Lucky once or twice is not going to make a career. Consistency is what helps us make a career. And here's a consistency that I wanted to share with you when it comes to what I've kind of done. Now, this doesn't look much like anything other than a white chart. And you'd say, well, what the heck is this thing? So I'm just going to introduce to you what it is. If you can imagine that this is the bar, the blue bar right there, that's these are where the market is relationship to its monthly opens. So if you notice this blue bar, we're in the final, just to tell you, it's not ready for release tonight. It's not ready for VIP members tomorrow morning, but we're pretty damn close to creating something very similar to the TSI indicator, where we're going to say, hey, what is the current bar relative to the maybe a 5-minute chart? Is it above the daily open? Or, for example, the daily, is it above the weekly open? Or the weekly, is it above the monthly open? Or maybe you want to just go, is the daily market now above the monthly opening range? Why would that be important? And one of the main reasons is because on average, 67% of the time, a market that trades above its monthly opening range after the first 5 days, generally you can suspect the low of the month is in. Now, if you look at that and you'd say, well, it didn't quite work here in June, John. That was your opening range. First 5 days said the low was probably in. And guess what? The low, it took it out twice. But for average time periods, it still stayed above the month. Here's another one. Opening range. 5 days, market went up. Here's another one. Market closes below the monthly opening range. Market goes down. Market closes back above monthly opening range. Market goes up. Market closes below opening range. Market go down. Not bueno. So I'm looking for something that I could say, I'm looking for a statistical edge in the market. And if you think about this, unless we get back to normalcy or normal pricing structure on an, let's say, I don't even know how you want to call it a normal pricing structure. What is a normal pricing structure? Well, where was the market 3 years ago? So for that, let's take a look. Where was the market 3 years ago? We'll go back and say, where was the market 4 years ago in valuation? If we get back to 211 in the SPY, and unless we get a dip, I don't know if the market would ever be lower unless the crash in 1929 happens. But if you go back and look at a history chart of the stock market, it generally progresses higher. I mean, there's dividends, there's participation, stock buybacks, etc. I don't want to get into the whole theory about why the stock market goes up almost forever. However, stocks that don't perform, that go out of business, get delisted, and then it's kind of like a cheating thing. Stocks that don't do well, that would hold the index down in value, they get bounced out. Stocks that are high valuation, the now, the new, the exciting stocks, like they just added Etsy. I've never even ordered anything off the online portal Etsy, but here it is, added to the index. Well, here's the story, gang. I think that the higher the market goes, the harder it is going to be to navigate risk. And I think one of the things that we're going to have to do is to be a little bit smarter about how we could figure out whether or not the high or low is in for a given session. So if you take a look at this monthly chart and humor me, you'll notice that generally times that the market goes up, the market for that month, these are monthly bars, by the way, monthly bars. Now look at these little teeny itsy bars. I mean, that was 2011, and that was good times back then. 13, 14, 15. I don't know if you guys remember that small little crash in 2016. If we had one of our live trade room members, Mike C, if he was here tonight, he'd be laughing his butt. And Mike, if you're going to watch this recording, which you probably will, you're going to laugh because I mentioned your name. Mike C, when we came into January of 2016, says, aren't you going to sell? Aren't you going to sell? Why aren't you selling short? I'm like, I'm actually longer term bullish. My indicators are suggesting we should be backing the truck up and getting a list of stocks to be buying on this breakdown. Not now. He was right as a short-term trader for about a week and a half. He was right, but I refused to sell short in the hole because I was looking for stocks to buy. My longer-term work suggested that we should be going higher, and well, as it turns out, we were right. At the end of of 2016, or the middle of January of 2016, that's when many of you might recall this little story. We can go through history. I think it was Royal Bank of Canada, RBC. Their head analyst said everyone should sell out of all their stocks, getting cash immediately. The head analyst for a major bank, institutional bank, said get out of all your stocks. Everyone should get out of their stocks. I'm not going to say he did it the minute the market made a low, but it was pretty damn close to the same day. It was pretty bizarre. So there are bizarre things. I don't know what a head analyst would see that got it wrong, because as you can tell, the market has never come back to that line in the sand or that low since yet. Maybe one day it does. I don't know. But since then, let's take a look at this. On a monthly basis, market opens, trades lower, gets back through the opening range, and then there's some green left to it. So again, maybe I drew that too much and I just got rid of that. But what I wanted to point out is that when we are looking at a trade in the marketplace, to get an edge of knowing, do we have tools that suggest the market's oversold? Sure. If the market drops down and then within, say, the first 5 or 6 days of the month, trades back through the monthly opening range, we have the supposition, we have probabilities on our side that suggest the low for the month is in. The reverse is true for the high as well. Markets open high, they open, they trade higher, and if it's truly bullish, think of this concept. Shouldn't the market still stay above the opening range and trade higher and be bullish? Because if, after all, the market is going to be bullish, we just went through a slide tonight, we should make higher highs, higher lows, and the close should be greater than the open, right? The close should be greater than the open. So when I come in and I do presentations like this, the market that I see and the statistical edges that I get and the trades that I like to put on, or I do put on, I mean, I like to say, hey, listen, guys, when I'm putting on a position, I want to put on a trade that I can get in with a good signal, a good setup, which, by the way, let's go over wrong. I want to get this one over here and use this particular one right there. If I know that current statistics suggest that, you know what, we've got a long way till we get to the end of the month. We're about mid-month. It's the 15th. And if I take a look at October and I see where the opening range is, if you humor me, and there's October. Let me ask you a question. I never said how we get there, but by the way, that's the opening range for the month. Question, are we above the opening range for the month still? Yes, we are. So I don't know how we could go from the open. We can go down, which we did. Then we can go back up, which we did. And we can go back down, which thanks to President Trump's tweet, it did. And then it can go back up. And it can do this. But at the end of the month, as the more time goes by, and as other indicators suggest there's buying pressure, we should stay above or positive, greater than the opening range. And to me, that is statistical vital information. And it also tells me which buy signals should I trust and not trust. If we're below towards the end of the month and we're starting to break below the opening range, let me ask you a question. Should I be taking buy signals maybe? Or do you think the odds that maybe the high for the month is in and it's a low probability that I'm going to make money buying that dip? So how would this also help other types of traders? Now, there's, as they say, 1,000 ways to skin a cat. We could trade ETFs like this is the SPY, which I'm doing, which I'm in. We could trade leveraged ETFs, which I do, like SPXL. We could trade options and use option strategies. I mean, if you're an options trader and you want to know, should I be selling puts or buying calls? Knowing if maybe the low for the month is in, that might be helpful information. And you may ride a little bit of heat, but on dips. And by the way, when do you make more money on selling puts? When the market rises or when the market pulls back? If you sell a put when the market's going down, the volatility generally goes higher and you get a little bit more money. So having a statistical odd edge and using maybe some having defined risk may give you the extra confidence you need to put the right trade on at the right time. And that's part of what our indicators are all about. What is the condition of the market? Are we in a convergence, divergence? If I need a volume tool and I want to know about the volume conditions, then I have one of the best volume indicators ever put together that I believe has been just instrumental in helping dictate whether or not a market's losing momentum or whether a market, like for example, this is real-time stuff. Take a look at a volume tool and compare an apple to an apple. When I talk about divergence, when a market makes a new high and breaks out, which by the way, that's a newer high than over here or down here or over there. It's off for screen. I can't. Let's move it into focus for you. Here we go. So here's a high, here's a high, here's a high. What constitutes a high? There is a reaction downside, reaction downside. So the market's made consecutive series of highs. Here's the volume tool. Here's the volume on that particular high. Here's the volume on that particular high. Boy, that's pretty good. Here's the volume on that. And most people that would use on balance volume would say, hey, this is great. Market broke out. It made a new high and blah, blah, blah. Even myself, John Person, have written that a market on balance volume trending higher is positive. So why do I say my volume tool is better? Real simple. It helps to identify if the market, as it's going up, as it's moving up, is the momentum of the volume going up with price or is the momentum going down with price? And by the way, you see that little red bar right there? How in the heck do you not want to be long that market if you were long and not take profits and not utilize that tool? Phenomenal. Which, by the way, many of you know we were in a long bull call spreads and we got out that day. We did reverse course and went into long bull call spreads today. So if this trade is to work out, I have the laws of probability on my side right now that I have a 67% probability that the low for the month is in. Now, it doesn't say I'm going to make money on this last trade, but it suggests that even if the low is in, and if the market wants to just maybe retest last week's or this week's high, Monday's high, I have a better than 67% chance of making money. And that, my friends, is the power of using higher degree education in the most insane business on the planet. It really is. I hope you understand that this has been one of the most, I mean, the headline news, it's almost comical on what we lived through from a COVID-19 era. I mean, not comic in the sense that people have actually perished. I'm talking about, I mean, you can't make this stuff up at a Hollywood movie. The political scene, let's face it, doesn't matter whatever side of the aisle you're on, it's comical on both sides. If you were able to be objective and take a look back from emotions and say, man, not in my lifetime would I imagine hundreds of people sitting on the sidewalk waving flags. It's unbelievable. And all of that, how we use monetary policy at zero interest rates, how we have fiscal policies, more stimulus checks, money being thrown at the world. It's and the disconnect of how high the market is when many economists suggest we're actually in kind of a recession right now. It's a total detachment from reality of our normal past economic history. That's what I'm trying to explain, and I hope I did that correctly. And I certainly, it's not my job to offend anyone. It's just my job to share with you the tools that I find that have been helpful, giving me a better edge in the market, and absolutely making money in this market, in this environment, and stock picking. So with that said, I wanted to make this a quick, short, and sweet event, and give you an idea of what we're doing. I also wanted to introduce you to the fact that we are hosting my annual 2-day seminar in person, live, believe it or not. For those that are interested, we're going to have, of course, the advanced social distancing, so we do not have a lot of room, and we're going to be hosting this again here in Palm Beach. You can go visit our website here. I'll put that into the live trading room, what the link is, and you can go and check that out yourself. And we'll put that in there right now. We're also doing it in a virtual capacity. And I know we are running a special right now that if you're interested in signing up, and for those that just bought my second edition book, I'm proud to have it here on my desk. And someone had suggested that I don't look any. This photo that they used was from the cruise. I was with Dr. Jeff Scott and his wife at dinner. That's where that photo came from on the book of this cover versus my first cover. And the difference is, you'll notice on this book, I have a lot shorter hair. When you cut your hair, you cut the gray out. I'm just saying, if there's less gray hair in this photo, that's all I'm saying. I did not touch that up, but thank you for noticing. I look almost the same as I did in this book as I did in other times. We are hosting this seminar down here in December. We're also having people, if they want not to travel, to come on a virtual Zoom sign in. So if we, and just like the little photo, I love that. Anything's possible. We do live in interesting times, and that's the old saying. The fact is, even in my lifetime, finally, the Chicago Cubs won a World Series. We can all, Harry Carey is now resting in peace for sure. So I want to say thank you for joining me tonight. I also want to introduce you to a couple things. Which, by the way, at this seminar, we'll talk more about that indicator and how we will run scans with an open close, how that's going to work for stocks. I'm very excited. It gives us a better edge. A lot of times we see a lot of tactical trickiness in this market. We call them pumps and dumps. Market gets slammed first and then takes off. We just saw that pump and dump with the Trump tweet. How volatile was that market? How unfair do you think that was, that the market went down on Tuesday, wiped out the long book, and then just came right back up again on Wednesday? It's amazing the volatility that we see, and it's amazing the valuation changes that we see. Look at Zoom, look at Amazon. I mean, look at the fact that Walgreens provides an amazing service. I unfortunately had to use Walgreens tonight for a prescription. a prednisone for, anyway, another story, another time. But I'm here happy to report that Walgreens is still in business. They pay a dividend. It's a great opportunity, I think, longer term. But with that stated, at this seminar, we're going to go through some of our stock picking. We'll go through our algo strategies. I'm really excited to give that seminar. It's once a year. Hopefully, the COVID-19, some people would think, well, why are you doing it in person? Well, I think social distancing is fine. And for those that are not comfortable in social distancing, we are going to do it on a Zoom. And one other thing is that the last time we hosted an event down here, I took a couple people out on our boat, and we went out sport fishing. Some guys were a little jet lagged coming. One guy came in from Hawaii. Another individual came in from California. And anyway, they were a little too jet lagged to want to grab onto the rod and the reel. And we caught, I think that day we caught 2 or 3 mahi. They were delicious, by the way. So anyway, it is going to be hosted down here. Maybe I'll look to see if we can do that similar thing where we take people out on a boat before, maybe a day ahead. And we can certainly talk about that. If you have an interest in that, let me know. I just need probably a day or two before the seminar, and we could certainly take it out right here off the coast of Palm Beach, Florida. I thank you for your time. I posted the link. I would definitely sign up for this virtual event and in person. Again, in person is very limited because of the social distancing. With that said, I thank you for your time. I wanted to make sure that everyone had a chance to go see the debates, if they were, or the town hall meetings, excuse me, that exist or are on TV. And with that said, I look forward to the next time we meet. Thank you all very much. And I will update everybody on the progress with our latest indicator, which I find to be fascinating to finally get off my ass and get together and finish and do, because I've been doing it manually for a long time. What I'm more excited about is to be able to run the scans to find out, and again, have as an indicator to find out, after all this treachery and reasoning, is the market greater than the line in the sand of the open? And that, I think, is going to have a monumental door open for a lot of us as traders. Thank you very much for attending tonight. I hope I made it worth your time. Thank you for choosing to spend time with me tonight on what could be an important presidential town hall meeting night. Thank you, everyone. Have a good evening. That concludes our time together.